Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast, our weekly 2 cents segment. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates, the founder of the Flint Group. Chris, how's things?
Hey, I'm doing well. We just had a weekend up in Newcastle. We didn't go skydiving if you're following along at home. We actually went whale watching, which because it was a really wet day, which I don't know if that was a better decision because we got soaked. But we did cruise along with 2 massive humpbacks for about 40 minutes, just part of their pod. They were just very happy to hang out with us. And so that was an amazing Sunday. And up in my hometown, Newcastle, how have you been? What's been happening?
That's pretty good. I did that once off the eastern suburbs in Sydney in the middle of winter, and it was pretty spectacular. It was quite cold, as I remember, but quite amazing to get that close up. You don't see many things that spectacular right up in the flesh. What have I been doing? I've actually been catching up a little bit this week on the Rask community chat forum. So it's mainly used for stocks and shares chat and personal finance type stuff, but there's also a little property section in there. So we've done a couple of quick fire Q&A episodes. So that's been keeping me busy, just catching up with what everybody's talking about. And work is just ticking along as it is, really. Still plenty of people transacting even at this time of year, but stock levels are pretty tight as well. So it's keeping us busy. A lot of sort of open homes where our buyers agents are turning up and there's still big queues out the door. Not much change in that regard, but otherwise pretty good. Can't complain.
Yeah, it's interesting you say that. I mean, that's going to lead into our first story. Obviously, every Sunday at 7 o'clock, we release these and we cover 3 big stories of the week. And maybe we kick off there, Pete. We'll have a discussion about story number 1, and then we can talk about what's actually happening on the ground for us. Because, I do think it's, when you say open homes are busy, I don't think all open homes are busy. And so let's have a chat.
Yeah, so this is a discussion that comes around most years, and you get that kind of winter slowdown. So this week we'll have about 2,000 auctions. So that's quite a significant drop from where we were a week or 2 ago. Now, that is more than we saw for the equivalent weekend last year. There was only around 1,500 or so. I think if you look at total listings, the stock on the market, I think this is something you touched on a week or 2 ago. SQM Research has 232,000 for the month. So slightly down from 256,000 in the month before. So again, I mean, if you compare that to where things were 10 or 12 years ago, very, very low, and actually pretty low this time of year. So generally in Australia, people aren't that keen now to list until the warmer sort of spring period. They call it the spring selling season. Plus, we've now got this interest rate uncertainty for the next few months. I think latest inflation figures spooked the horses a little bit. I think there's been a bit of chat around the traps. You're keeping your ears to the ground about power prices. If you look at electricity futures, that transition to renewables in Australia hasn't been that smooth, and some people are just worried that could cause inflation to stick around for longer. So, most people are forced sellers despite the change in interest rates, and unemployment's still pretty low. So, at the moment, not that much stock. So, if something good comes along, it still seems to be pretty busy.
Yeah, I think it really depends on the purchase price and then the target market that property is appealing to. I think there is definitely, I feel, where there's parts of the market where it's got a lot of competition, you've got a lot of buyers, you've got a really, I would say that's usually on the lower part of the suburbs. It's usually where people are desperate to get into the suburb and they're just really competing on the B, Cs and Ds. When you get to this sort of the A grades in the suburb, yeah, they're absolutely selling, but I don't think people are just flush with cash. I think they're either borrowing from family or they're really struggling to, get money from the bank. And so the family is saying, I'll help you, but to help you go and buy the best property in the suburb is really hard to justify, right? And, asking for that extra 200,000-300,000, let's call it, to get there. So I think you're finding that. I think you're finding where budgets are tight. People are still getting help from family, but that's not allowing them to sort of really stretch. And then the buyers that do want to stretch are really struggling with borrowing capacity. And so when you look at a market, I've got a number of clients I've been looking at what they're buying, and you can see that they're spending, they're looking to buy just a bit above where that's, there's a glut of buyers, and what they're getting is really good value for money and actually a better price, I would say, than they would have got maybe 12, 18 months ago. The problem is there's very little properties on because at these price points, because everyone's holding on to sell. That's holding on because they're not forced to sell. And so what you're finding is that, yeah, they're there, but then they're staying on the market even if they're a good asset. Because they're saying, well, I'm not selling at that price because I think it's worth X amount and there's just not enough buyers at this at the moment. And so I do think it's a little bit of a mixed bag, but that opportunistic upgrader is absolutely there, but they're very hesitant. They're really struggling with borrowing capacity. And they're not feeling a real urgency to transact because they're going to open homes and they're saying, well, there's just no one here. But they're not willing to meet what the vendor really wants because there's no pressure for them to buy because they're not finding there's a bit of FOMO on the market. And whereas if you just drop a little bit down in the same suburb, you could go to a different open home and it could be really busy because there is a glut of buyers at that price point and people are all stretching to their maximum capacity and what they can get from family. And so it is really interesting. I mean, this time of year is always a bit of down in the doldrums. I mean, in Sydney in particular, it's wet and cold and you got school holidays up at the moment, etc. So you really, and all the agents usually go away at this time of year to, to spend their commissions on holidays in Italy. And so basically, July is really a real quiet period. But we usually see, inquiries start to pick up from, maybe next week to the week after. And it's going to be interesting to see what happens over that period. What if people start to come back with a bit of urgency, same as over the Christmas period. The buyers usually start coming in January, even though listings aren't coming and they're getting ready for spring. My gut is that we're going to still see very low listings this second half of the year. Everyone's going to be disappointed again because the reality is that the recent fear around interest rates going up again, even with inflation data a couple of weeks ago, is just really going to say to an owner of a property, maybe you shouldn't upgrade. Maybe we should just be a bit more conservative. Maybe we should just stay where we are, not transact because rates are going to be high for longer and rates are going to be high. And so it really, constrains listings, this fear around rates. And that just this last little blip again, there was another blip back in May time when there was an extra fear around higher interest rates. I think you're going to see very low listings. And I think buyers are just going to be, constrained because of borrowing capacity.
It's interesting you say that because I've heard from Melbourne that, as you said, really good properties can be quite hot with a lot of competition, but generally there's a kind of a lackluster feel to the market. A lot of people just not that willing to transact, sitting on the sidelines. I was chatting to a mutual friend, Kate Bakos, who's one of the top buyers agents in Victoria, and also was previously the president of the Real Estate Buyers Agency Association, and she said she's had a lot of situations where people are pre-approved, they've come to her, but they just not really willing sort of to take action. And she's almost like, well, what are you waiting for? You've got an opportunity to buy. According to CoreLogic, figures out this week, we had, for Melbourne, prices were down 0.2% for the month in Melbourne and 0.6% over the quarter. But Kate sort of say, well, what are you waiting for? You're waiting for it to get busy and then be bidding against other people. But that is kind of the way it seems to work in property markets. People like that social proof of having a lot of other buyers around. Now, if you look at the CoreLogic figures, few interesting things. Strong price growth, very strong price growth actually in Perth, 24% over the year and 6% for the quarter. Brisbane and Adelaide still very strong, 15% over the year. Sydney, 6% over the year. But much softer, pretty much flat year on year for Melbourne, Darwin and Canberra. The thing that surprised me, Chris, is when you look at price change since the onset of COVID to June 2024, the combined regional markets are still up by more than 50%. I would have absolutely staked anything on the fact that they would have had to come back a bit as interest rates have gone up. But I think, as you've pointed out just before, the reason for that is just the sheer lack of stock. There's just not enough supply. not enough people are selling and more people are buying, and it's just held prices up. So it just goes to show you never quite can predict these things. So yeah, a lot of uncertainty, and maybe the stock levels will just stay low as we go through the second half of the year.
Yeah, I think the interesting thing is, the more you've sort of been in the market, watching the market, you sort of, the cycles, and you get less concerned about the present day, and that things are going to change quite rapidly. Things are always going to shift. And I think what we like to do is stay really agnostic to it all and just go, okay, well, based on everything right now, how are buyers and sellers feeling? How are they changing their decisions, based on their concerns or their fears or their opportunities in the future? And I think things can change really quickly. Sentiment can shift fast. And it can change, basically with a couple of good news articles. And, if inflation is now getting killed and interest rate cuts are coming at the end of this year, well, that sentiment's going to get really quickly factored into prices if it builds up over a couple of months. And I think that's what buyers are ultimately wanting to do, is that they're basically on the sidelines, but until they have that confidence around where rates are going, there's no urgency to transact. However, when that switch gets, flipped, that's going to happen really fast. It's going to happen on very low listings. And I can see a 2019 type of response here where buyers start to stretch into the market. They start pushing up prices. They start moving suburbs, and you start chasing the market and to get in. And I think that second story, Pete, which is around sort of the rental crisis a bit more, I think that's one of the key things that are driving prices as well, is just this, I can't rent long term. I've gone through a lot of pain. It's not going to suit me. Yeah, I don't want to pay these prices for property, but I don't want to rent either. And I prefer to, and buyers are making more compromises than ever. I think that's been something I've noticed more in the last few months.
Definitely, yeah. So the second news article, it almost rolls on from the first, because CoreLogic reported rents were up in June, and they've been up month on month relentlessly over the past few years. 0.4% increase in June and 8.2% over the year. But both of those figures were the lowest since November last year. So look, rental markets are still tight, no question about that. And some of the CBD fringe areas might tighten again when international students are back in full force. But there is some suggestion there that the rental market might just be adjusting to the new normal. Maybe in some markets bumping up against an affordability ceiling. And I think that's potentially some good news for the battle against inflation. I think this week the Melbourne Institute saw the core inflation and its gauge back down to 3%, which is basically the RBA's target. And obviously rents have been one of the key factors that have kept inflation sticking around. There's others, the insurance and electricity prices and energy bills and so on. But yeah, I guess there is that. I think, but you're right though, Chris, this is just a key factor that has got so many first-time buyers, first-time investors just trying to tap any way they can to get into the market, because the rental market has just not been a fun place to be over the past year or two.
Yeah, absolutely. I mean, I think it's that natural affordability curve with rents has got to kick in at some point, right? Like, we can't just keep charging higher rents, and people will start making more and more compromises. They'll let go of that home office. They'll flat share, they'll move back in with parents. I do think there is that natural sort of ceiling on rents. And I think that's been smashed open in the last couple of years just because a lot of investors are leaving. And I think over the next 12 months, I think that's going to be a real story we're going to continue to see. Yeah, listings are coming, but who's the one selling? Who is selling right here? Is it houses in the good streets? Is it apartments? Is it townhouses? Is it an investor hotspots? And I think that's what you really want to track, is that not total listings, not city listings, houses and apartments. What suburbs and where are you starting to see a glut of listings? And that's usually where you'll find that days on market will shift out. You'll see that buyers there's no urgency there. And that's where you see markets really soften. And I think that's if we start to see more and more investors sell over the next 12 months, which I absolutely will see. Could even think of two clients I've spoken to this week that are selling, want to upgrade and just to make their cash flow better, to be honest. I think you're going to see this rental crisis continue, but maybe just rents can't go up, but you are going to find that there's still lots of competition to rent. So, what's story number 3, Pete? We're rattling through them pretty fast today.
We are a bit, yeah. Let's just to add to your point there on the rental crisis. It's that old debate, isn't it, about when people talk about inflation. Inflation is cumulative. In economics, people tend to talk about inflation, the year-on-year figure, but it sometimes overlooks just what has happened to prices over the previous few years. We've got to a little period where inflation's been very high, especially for things like food and travel and eating out. And yes, year on year, the inflation rate might be slowing. But if you add up all of those price changes from 2020, 21 through to today, there's been some monster increases. And yeah, it's a bit like that with rents. I think CoreLogic said national unit rents are up 22% over the past 2 years, compared with the 16% in house rents over the same period. And affordability metrics showed that median income households would need to dedicate 32% of their gross income to rental payments. Now, those figures are always a little bit broad brush, and there's different income quintiles, and it's one figure to sum up quite a diverse market. But it does show that, yeah, generally speaking, you're bumping towards an affordability barrier there. And people just start, as you said, they start making compromises. They just get to a point where they say, look, instead of paying X $100 a week, I will try and find a different solution, whether that's more people per household, or whether it's people staying home with parents for longer, or whatever it may be. But there is just a point where you get to an adjustment. Now, I guess, yes, so we may well find that with immigration slowing in 2024 in the second half, eventually we'll start to see that year-on-year figure for inflation and rents actually slowing. But actually, yeah, even now, rents are still going up, and not at a slow pace necessarily. And so affordability is getting worse even as we speak. So yeah, it's one to watch. I think the interesting two things for me to watch will be what happens when we've got the summer term with all the international students around, and then that Christmas period, which is always a funny period with people coming and going. And secondly, just what's going to happen in Victoria. There's been so much change over in Victoria for the reasons we've outlined in previous episodes. Low rental yields, a lot of investors coming out of the market, land tax, and then there's been changes to tenancy rules and all these things. How is the Melbourne and particularly the Victorian rental market going to hold up? Because there's massive population growth. Not so many landlords are that keen. Their capital doesn't seem as welcome as it once did. So that'll be just, I don't know the answer, but we'll have to just wait and see how that plays out. So, yes, Chris, you're right. Let's get on to this third story.
Just on Melbourne. I mean, I've said a few times on here now that I probably would put my bets on if I had to put my chips on one capital city over the next, 5 to 10 years. I'd probably bet on Melbourne if I had to go for a growth play. And, counter-cyclical, if you had to draw a line in the sand now, and I think you get yourself a decent house. Not the apartments down there. I'm not a fan of apartments in Melbourne. I know some buyers agents are, and some very prominent people are very fans of them. I just don't see that story playing out because I do think if prices go up, developers will have a bit of a free run down there, and like they have for decades, and I think they'll just keep on building. But I am very confident around the sort of heritage sort of family homes down there in premium suburbs. I think those heritage overlays, they're just great places to live. And that's what Melbourne's all about, is the cafe, restaurant, footy, parks, access to the city, and good transport in and out of the city with the trams and the trains. And they're doing everything they can to make Melbourne as a city even better, right? I don't think it's going to lose one of the best places in the world to live, but I do think the last few years have been really tough for Victorians, particularly going all the way back into COVID. And so I'm betting on Melbourne. I think, look at the growth in other parts of the country. I think maybe the party's sort of getting running close to its end. However, what we've seen in previous boom cycles is when you think things are over, it doesn't necessarily mean they are. You can easily see another leg up in investment markets or in property markets. And we saw that if you go back all the way to 2016 in Sydney, everyone thought it was done, but then it came back and it roared up in 2017 and had another big leg up. And so, the Perths and the Adelaides and the Brisbanes and things like that, they've been going up a lot. But what happens when interest rates drop, right, and borrowing capacities go back up? Maybe there is still another run in there. But if I was going to bet past that longer term, I'd be betting on Melbourne personally. But I don't like to forecast, but I've just got to, I do think the fundamentals are there, because as more and more investors leave, you're going to start to see a rental crisis. You're going to see really strong population growth, and there is a bit of an affordability play because they haven't gone up quite a lot. It hasn't gone up really for 3 or 4 years as the rest of the country's been going up. So story number 3. But
yeah, there's definitely that thing, isn't there? If you're betting on which market will produce the strongest price growth over the next 6-12 months, I think it'll be hard to look past Perth. I think the supply response may be starting. But yeah, if you're an investor in property, or a home buyer for that matter, it's more important what your returns are going to be like over 5 or 10 years, or maybe longer. The longer that time horizon is, the better the case really looks for Melbourne, I think. It's even if in the short term, as you said, in the doldrums a little bit, but then you can buy with less competition. And there's a relative affordability thing at play as well versus prices in Sydney, which does tend to shift capital that way. So, yeah, all right, let's crack on with the third story of the week. So Cameron Cusher did a piece for PropTrack why the housing accord targets won't be achieved. So, interestingly, this week, being a new financial year, the government's housing accord target of 1.2 million new well-located homes over 5 years, well, that starts this week, 1 July 2024. So if you break that down, as Cameron's pointed out in his piece, and we'll link to it in the notes, 240,000 new homes each year, or 20,000 homes every month for 5 years. So in fact, that's one every couple of minutes when you break it down to that level. So Cameron's sort of gone through some stats. If you look back to the previous cycle, we did once see, I think it was 2017, where we saw 224,000 new homes built. So, and that was a crazy time for apartment construction. But Cameron's pointed out a few things that are different today that will make it very difficult for us to see 1.2 million homes over 5 years. Firstly, interest rates back then were 1.5%. Now they're 4.35%. So interest rates are one. Construction costs are up about 40% since the onset of COVID. So it's really difficult to make new projects stack up at the moment. We're seeing a lot of corporate insolvencies, especially in the construction and development sector. Competition with the established market. I think maybe Perth is one exception. I think potentially the price growth is actually making it viable now for new homes to get built. I think just in other parts of the country, the gap isn't big enough between new and established property prices, and the supply response will come, but it might be a year or two away. And also Cameron pointed out fourth point, and that's just the planning system may need to be streamlined if we're going to get anywhere near these kind of numbers. There'll definitely be a big push over the next year or two in states like New South Wales, more density, particularly around train stations and so on. So, yeah, it's a very interesting piece. Look, I tend to agree. I think 1.2 million homes over 5 years, it's hard to say, to be honest, but you may well start to see as we go, as prices rise, you might start to see that supply response kicking in. I think it already is potentially in WA.
Yeah, I think this is going to be really just the numbers adding up. What can people borrow? What can people get access to? And what can developers sell at to make a profit? And I do think that needs to be a bit of hand in the pocket from the governments here to figure out a way to make those feasibilities work, whether it's changing zoning or whether it's changing taxes and giving a few free kicks to developers to make those numbers stack up. I mean, the reality is those numbers don't add up right now. And what we just chatted about a couple of weeks ago is the cost to do new over existing is there's a premium there. So it's actually better as a buyer to buy established because you can get more value for money than you can if you buy something new. You're going to get more land, and than if you try to buy something brand new that, you know, it's hard to have a lot of confidence in due to building issues and builders going under, etc. And so you just go and buy an older house and then renovate it over time. And so I think these numbers aren't adding up right now. I think developers are, knowing that it's a long-term play. A lot of them have burnt a lot of their liquidity buffers, and they are land banking, and they're saying, look, we're just going to batten down the hatches. They're also competing with labour ridiculously, even every, you think that, the big government outlays are going to stop, and then you flick open the Age or the Sydney Morning Herald and, oh, hang on a sec, we're now building another light rail, or now hang on a sec, we're building another metro line. So I think these the government spending and even the things like industrial, etc. I think these are taking a lot of our labour, Pete, and those numbers just won't add up, particularly if we start to cut back migration and we've got less workers. What's your take, Pete? I mean, there will be naturally pockets where, the downsizer market and the developers can absolutely build, and it's, you look at the Gold Coast right now, it's almost every day I track that, and there's a new tower getting built along, Palm Beach there. But what's your take, Pete, on this supply number? Are we really going to see a lackluster response in our capital cities where the numbers don't add up, and just certain pockets around the country where developers go, yeah, this is making sense, we can make some money here?
Yeah, in fact, Cameron made very, very similar points in his piece. I think where you've got areas where developers can target downsizers who probably want a larger apartment, more exclusive building, maybe an ocean view, stuff like that. Yeah, those markets are working. And I think the issue is, and comparing back to 2017 again, I think it's not very popular in social media circles to say so, but nevertheless, the only time we see these big construction booms is when investors are buying the new stock. And Cameron, I'll just quote from his article, investors were a vital cog in making new housing construction, particularly apartments, viable. And the share of new lending to investors over the 5 years up to 2017 was 37%. And compare that to the past 5 years when it's been under 30. I think, yes, there was a lot of non-resident investors in the market back then as well. Now it's just gone out of vogue. If anything, the state government seem to be more keen on raising taxes for foreign buyers, which seems to me like an oversight, really. If you want to get more supply, why would you block people from buying new properties? But they're just doesn't seem to be politically that popular at the moment, even with the state elections going on. Yeah, my gut feel is people might be surprised by the size of the supply response, but it could just take a year or two for that to get started. I think it's at the moment it's difficult. I was just looking back when you were chatting there, Chris, at the big sweep of interest rates from, say, around about 2011, when we had 4.75% cash rate target, and it just fell and fell and fell. And by 2017, 1.5%. And that's when we saw that massive construction boom. And in fact, in recent times, we went to zero. But 4.35% is a whole different ballgame in terms of financing new developments. And yeah, I think as well, as you said, there's not that much access to credit. Interesting, there's a couple more pieces over the past week. I think it was ANZ, Shane Elliott saying, you're just making it too hard for us to lend to the average buyer. And so that sort of train is being pushed a little harder now as well. But at the moment, investors in new apartments, not really. It's mainly downsizers and people looking for lifestyle choices, I think.
Yeah, absolutely. So I think it's going to, not much supply, still obviously a rental crisis. Sounds like we're beating the same drum every week, but coming into the winter periods, very low listings, but we're not sure how much sentiment can shift. I mean, I was just literally reading some points there by the Kook, right, basically showing that inflation is looking pretty good. Even though we've had this monthly inflation looks pretty poor, Westpac is saying the inflation's looking pretty good coming into the second half of this year. And, some just articles like that, compounding in the media, and all of a sudden, actually, no, it's not one more rate increase, or it is. The other thing is to consider, though, is if rates go up, is that a bad thing? Yes, it'll obviously make it harder for people with debt and households that are already struggling with mortgage, and that'll slow down inflation, which is kind of what we want to do anyway, right? But does that mean the rate cuts are earlier? The higher you go, the earlier you've got to cut. And I would say that, the confidence around, even if rates do go up, that means probably a cut's coming, maybe a little bit sooner, assuming that, that it does its job. And when those rate cuts start happening, then the whole sentiment shift is that now we're in a downward cycle of rate cuts. And once that first rate cut happens, very similar to back in 2022, when the first rate increase actually happened, you could see that was a bit of a circuit breaker for the market, and prices started getting adjusted pretty quickly after that first rate increase. I know, because I actually bought the day before that rate increase. But I think that's what we're going to see is that, rates may go up and may not. But if they do go up, I do think that may bring us a little bit closer to when that first rate cut happens. And I think that'll be when there's a real confidence back in the market to actually, let's get ahead of these rate cuts. But unfortunately, that's when a bit of a stampede will come in the market at the wrong time. They should have probably entered a little bit earlier before the confidence returned.
Well, that was always the argument, wasn't it? By not going as hard on interest rates, it could end up, the Reserve Bank could end up seeing inflation stick around for longer. I think that there's a number of reasons why inflation hasn't come down to the target range in Australia just yet, which we don't need to go into today. But there was some more soft data in the US over the past week, which more or less shows the inflation's been beaten over there. I think there's a few lagging housing costs, but just like in the UK and Europe, the conversation or the narrative is now shifting towards how soon interest rates can be cut. Maybe November for the US. Australia's got further to go on that journey, but a lot of the data is still pretty soft. Job ads were out this week, 26% now, down from the highs of 2022. So that suggests unemployment's going to rise. Commodity prices have been easing. So there's I think we're clearly in a contractionary place. Whether or not we need another hike, basically we're not going to know till 31 July. And that'll be an exciting morning for the data nerds because we get not only the next monthly inflation figures, but we also get the official quarterly inflation figures. And then that will more or less determine whether we get a hike or not. In the first week of August, I think if we get a hot print, then the RBA will be forced to go again and then just hope that things start to come down. But I think if you look at, certainly market pricing, there's been a bit of a shift in recent times. I do think maybe power prices are parts of that battle, which, have been a sort of an unexpected loss for the Labour Party. But interesting times ahead. So, Chris, what have you got planned for the weekend?
This weekend we're actually having a bit of leaving the kids for a night, actually, which is a pretty crazy thing for us to do. We're going to leave my grandma's for the night and go out in the city with my wife and a bit of a date weekend away, which we're finally getting to those ages where we can leave them with the family for a night, which I think we've only done once before. So it's a big thing for us to be able to go out for dinner without the kids and wake up in the morning without them. So, a bit of a romantic weekend away, you'd call it. What about yourself, Pete? What's happening?
You'll spend all weekend talking about the kids. I'm going on a scouts camp on Saturday. So, but of course, England. This is actually going out Sunday morning, so you'll know the result probably. But England are playing in the quarterfinal of the European Championships. I'll try and catch that if I can find a way to watch it. But unfortunately, I've got a nice camping to endure. So. Fingers crossed for a bit of better play because England have been, how should we say, somewhat lackluster in the tournament so far, but we're still in, so we'll see how we go.
Yeah, absolutely. Jude Bellingham, 96 minutes. I was actually up watching it maybe a couple of hours after it started, but not at 2 a.m. But
oh man, I saw the LinkedIn posts on LinkedIn. What can Jude Bellingham's overhead kick teach us about business mindset? I know it's just like this. That's too much, man.
That's it. Yeah. Jumping on the bandwagon, but it was a cracking goal. So thanks everyone for tuning in. It's Sunday now. So we'll have a good idea of who's got through. So thanks for all listening. We look forward to having a chat with you all next week. Show notes, you've got access to myself and the team at Flint. You can follow Pete's blog and reach out to his team for any buyers agency. So thanks so much for listening, and we'll chat next week. Thanks, Pete.
And join us on the Rask community chat as well. Lots of good content and feedback there as well.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.